Hi, folks. Before we get started, I want to remind everyone listening to this live and to the recording, the purpose of this conversation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, members, subscribers, affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. I want to thank the community for tuning into this conversation with Jacob Weaver. Jacob manages Cable Car Capital LP, a San Francisco-based investment advisor and general partner of Funicular Funds LP. Mr. Ma Weaver graduated from Columbia University. He is a literature major, and then he got his master's in statistics. That's quite a barbell. And he also has a CFA. He's a CFA charter holder. Funicular Funds has produced around a 17.1% net annualized return since November of 2013, their inception, which is pretty incredible performance. The fund is closed to new investors. For the Microcap Club community listening live, feel free during this interview, if you have any questions, press the Q&A button on the bottom of the Zoom screen. You can enter some questions there and we'll try to get to them at the end of the conversation. Jacob, thanks for joining us.
Thank you. Yeah.
Well, I guess first off, how does a literature major become a multi-strat hedge fund manager?
Well, it's one of those things where I had a lot of interests and I was never able to narrow them down. So investing was a good way not to have to choose. Literature, I like to joke, one was for love, one was for money on that barbell you mentioned earlier. And it was actually the statistics degree that I think I was pursuing out of interest. That's the thing that governs how I think about the world probabilistically. It's sort of more art than science. I ran very much in the opposite direction from some of the quantitative methods and finance coursework I was doing. But it's literature that's hard work, the close reading of financial statements, just like you would a work of literature that I apply the most day to day, I think.
Yeah, when I started out my undergrad, I was a psychology major, and I think my junior year I pivoted to an econ major when I realized that I would have to go to school for another 22 years to make a living, being a psych major. So I understand kind of the barbell approach. It's kind of how it worked a little bit for me too. When you started your fund, I think that was back in 2013. What was your focus at the fund at that point in time? How were you generally investing?
Yeah, I got my start as very much a traditional stock picker. The roles I'd had before starting Cable Car were in the long short, long only world. I'd been at 3 funds, including an internship. And so I'd gotten a sense of a few different styles, but knew at that point I wanted to develop my own. And it was a time period where I was young and I felt like the opportunity cost was never going to be any lower. And I was lucky to have family support to get started with a very small pool of capital that was at least enough to keep the lights on.
There we go. Now we can see you.
Sorry about
that. Yeah. Your returns that you've put up since inception are rather impressive, and it kind of proves that you're doing something different than most investors. What do you think you do that most investors, even professional investors, don't do?
I think there are a few sources of return, and I want to disclaim anything I say about the fund with the fact that we are closed. We're not trying to promote ourselves here, but Ian's a friend, and I wanted to participate when he suggested it. Historically, the fund started off a little more concentrated, and so there was an element of return just from a few good security selections in the early years. But I think what's been consistent is that I really cut my teeth as a short seller, and I am proud of a actual absolute return profile from the short selling side of the book. That's largely from focusing on hard catalyst, hard to borrow situations, which also tend to create a lot of capacity constraints within the strategies. So one of the things I think we've done right is to avoid getting too big and grow beyond the point where we can actually make money in smaller capitalization securities. And somewhat unusually and somewhat carefully, with lots of scars to show along the way, we have been willing to short sell within the smaller capitalization, microcap part of the investment universe. And while that's been successful, it's also been at times very stressful.
What what types of things normally attract you to a short position?
So early on, I had this view, maybe going back to the literature degree, that I wanted to be like Don Quixote and really tilt at windmills. Of course, he believed the windmills were not windmills and that they really were knights and dragons, as it may be. But I think the realization when you pick battles and you try to fight the market sometimes on a perceived fraud or instance of wrongdoing is that sometimes the return on time and the return on attention isn't what I would like it to be. So early on, I did some activist short selling. I wrote up some positions that I had a very deep seated belief really ought not to be public companies at all, quite frankly, due to the things they were doing. And while I had mixed success with that, I really didn't love the risk reward setup. There's a sizing component of an activist position that you spend months on. You need to make it really big and, in effect, commit to covering after you publish your research, because otherwise you have an untenably sized position. And that's very much the opposite of what I wanted to be doing. I wanted to be covering never in some cases. Which that particular model, I have a lot of respect for people who are able to implement it because it's quite challenging. But I will say that early experience of looking for frauds, looking for wrongdoing, trying to respond to it, it led me in a few different directions that proved helpful later on the short side. So one of them was that when you see something, say something. This idea from the NYPD, I guess, does apply in the markets as well, but that something isn't always a short position. So if a company is engaged in wrongdoing, you have to actually look at what the constituency that's affected might be. And one of my early lessons was that if you are, let's say, stealing from your customer base, perhaps in an obscure way, some customers don't realize it, for the benefit of your shareholders, that might actually be a pretty decent business model viewed, amorally and solely from the standpoint of an equity investor. And those are not situations that you necessarily want to have a concentrated short position in. However, it might be a situation where litigation could bring about some change in the company's behavior. It might be a situation where regulators would get involved. And so, from a fairly early time in the fund's life, I started expanding what I was trying to do. And before we formed the fund, we actually started with separate accounts. We raised an SPV to try to bring litigation against one of our prior short targets. And while that particular case was unsuccessful, I learned a lot about litigation as a response to wrongdoing. And that's been productive in a few instances. And we've also been closely involved in some regulatory conversations where it didn't necessarily make sense to commit capital to a position, but we could still bring about the change we sought and sometimes have some at least potential financial return associated with that. So that was one vein. And then the other one was just spending years doing it. You learn a lot about stock loan mechanics, and that's a marketplace that is quite inefficient. And nowadays, a lot of our opportunity set on the short side really comes from trying to source hard to borrow supply across many different custodians, many different stock loan relationships that I've developed over the last decade. And, essentially, sometimes if we can find borrow where others can't, then that is the entire potential return stream.
Yeah, thanks for sharing that. I know, I think in one of the letters I read that you have 8 custodians now, um, which for those of you that aren't aware, it's like a lot of funds have one or two, but not many that I've seen have, you know, 8 of them unless you're, managing 10 billion or plus dollars. So it's impressive to see across 8 custodians, and you kind of hit on one of the areas. I mean, you do so many different strategies, and some of them, as you said, it kind of caters to your shorting. And I think one of those areas is that you mentioned too is like litigation funding, and that's a way to kind of express potentially your short view on an equity is to just layer that on top of that. I'm just curious, like on the litigation funding side, how does that work structurally? And if you can give us an example, it doesn't have to be a real one, but just how does that work?
Yeah, broadly within litigation funding as an asset class, I think there are more than two, but two large buckets you could think of. One is sort of more claims trading. So there's an existing claim of some sort, maybe a settlement has been reached or litigation is at an advanced stage, and the holder of that claim just needs liquidity and is seeking financing in order to advance that in time. That's not dissimilar from any other sort of secured lending that may be available to any market participant, and it's not really my cup of tea. We have no particular insight. We're not staffed with a team of lawyers who can evaluate the quality of the ultimate receivable there, and we're not trying to earn fixed income rates of return. The other side of litigation funding is I think maybe what most people think of, which is the idea of providing capital to close a gap in a litigant's ability to bring their claim in the first place, which is something that structurally happens a lot outside the US and markets where you have adverse cost as a risk. So that's the situation where if you lose your litigation, you actually have to pay the other side's legal bills, which is one reason that, particularly in a lot of English law markets, there simply is less litigation than in the US, where we have a reputation for more of it. But a market has arisen to address that, and there's adverse cost insurance you can purchase, and there's a well developed funding market so that meritorious claims do still make their way through the court system. That's part of it. I think within the US as well, you have situations where sometimes a claim has merit, but there is some risk associated with it, which is more of a financial risk. And I think that's really where funders can step in and address differences in risk profile between both plaintiffs and their counsel. So we have a well developed class action space and contingency funding model in the US where essentially lawyers and their clients can share risks based on their respective balance sheets and tolerance. And contingency funding addresses most of that, but you do still have gaps where even the counsel may not want to take all of the operational risk of prosecuting a claim, even though it's worthwhile, or the size of the financial constraints or the collectability may be difficult to underwrite. And those are all things that I think financial providers may potentially be well positioned to address. Sometimes it also can look like just helping a law firm, uh, especially a smaller one, get into a new line of business. And you're essentially providing working capital for the law firm to do a large quantity of business in a particular space. So for us, this, I don't want to overemphasize it. I mean, we've done maybe 10 litigation related investments over the last few years, and they've all been, most at least, have been outgrowths of prior investments that we made within the equity portfolio. But it's essentially where I have some knowledge to bear that I think can, in a differentiated way, help the law firm or the plaintiff have access to justice, then I find it really compelling to do so. So it's been a nice uncorrelated way to express some viewpoints that otherwise aren't represented.
Thanks for sharing that. One of the other areas you mentioned what in the letter was, and I don't know if this is a new strategy that you're implementing, but an India IPO strategy. That piqued my interest a little bit. Can you talk about that?
Yeah, India is an interesting market. One reason we end up having a lot of custodians is when a particular trade presents itself that we're not set up to implement, then one a natural outgrowth of that, if I'm interested enough in it and the return is there, is to do the paperwork exercise and go open the new account. So in India, to trade locally, unless you have access to a swap provider with capacity, you need to actually register with the local authorities, become it's called a foreign portfolio investor, and it's a very painful paperwork process. But long story short, we opened with Kotak for a trade that we had where there was an arbitrage between a US listed ADR and its underlying in India. And so we got open for that particular trade. And then afterwards, we're sort of looking at that account and thinking, all right, what else can we do in India? And valuations at the time weren't particularly compelling to me. And on fundamental trades, I do still emphasize getting to know management and doing some on the ground research, which is not impossible from afar, but certainly more logistically difficult than companies that are here in my own backyard. And so, what we ended up doing a lot of, just as one piece of that particular account, is that we participate in various equity capital market CCM strategies in all markets that we're paying attention to. And there happened to be a bit of a boom last year. I think it's less the case at the moment, but it's cyclical, and I'm sure it'll be back someday. Where new IPOs in India have a structural feature where some of the local um, funds are essentially forced to buy them on day one. And it's due to that structural bid that, coupled with some retail enthusiasm, it's a very retail heavy market. You may have seen statistics where I believe the highest volume options trading in the world is actually in India. Very popular 0 day to expiry gambling that goes on over there, and was recently in the headlines with Jane Street and their alleged market manipulation within that market. But leaving all that aside, that same sort of animal spirits were present in the IPO market. And so you'd see a lot of issues open at multiples of the IPO price. And somewhat unlike most IPO processes in other markets, it's a straight pro rata allocation of what you ask for. So an issue might be 200 times oversubscribed, you'll get exactly 0.5% of your requested allocation. The only limitation there, unfortunately, is that you do have to block the capital. So in order to get that 0.5%, you do have to put up 200 times as much cash for a few days. And that somewhat constrains the ability of that strategy to generate really outsized returns. But it was a lot of fun.
I didn't know if you were going to be going long those IPOs for a period of time, or if you were actually going to be shorting them. Knowing that they.
There's no borrow market for that sort of
Okay.
thing. India does have a stock loan market, but it's limited to optionable securities. And it's not very liquid, unfortunately. But no, this was pure IPO flipping, buy and rent the
Yeah.
securities.
Another another strategy I see you talking about is buying. I believe you're buying negative EV biotechs,
Mhm.
um, and I don't know if ORKA was one of them, but I've seen you be active in that area. Is that an area you're still active? What attracted you to that, and are you normally trying to become activist or subjectivist in those scenarios to try to get capital return to shareholders?
Yeah, so funicular and cable car more generally, I am not usually a deliberate activist. With the exception of the historical short reports we did, my attitude is that I certainly don't want to get involved in a situation where business is badly managed. That being said, if I'm already involved, then we'll protect our interests, and of course we'll seek to achieve good outcomes. But in general, I've shied away from the deliberate activist investing strategy that's familiar to many listeners. That being said, we did make an exception for the current down cycle in biotech because it was a playbook we'd seen before from two prior down cycles in kind of the financial crisis timeframe, 2008 to 2010 or thereabouts. Again, about 7 years later, there was a capital downturn in 2015, give or take a year. And again, beginning in 2022, my view is that the biotech industry has one of the clearest capital cycles of any industry. And I think it's because, in addition to whatever the market may be doing, which drives certainly, as we saw in the financial crisis, capital to flow in and out of equities more generally, including biotech, there is a bit of a secular trend of companies that need funding getting that funding for projects that are more or less marginal. So if you think about the entire universe of research that ought to be funded, and people may have their political views on whether science should be funded at all, but I'm of the belief that science generally is a good thing for society, and people like to invest in it because it's uncorrelated from what the market does in terms of the actual outcome and whether the drug works. But there's still going to be some projects that are more marginal, right? That they're things where, yeah, maybe it helps extend the cancer patient's life by a month or two, but it's not going to be curative. I think most investors would, if they had to prioritize, and investing is a prioritization exercise, they would fund the potentially curative disease modifying drug before the one that is just going to improve quality of life a little bit. And sometimes financial concerns get into that calculus as well. But I think the bottom line is that in periods of excess, some marginal projects will get funded, some companies will go public earlier than they should have. The pre-phase one kind of animal model speculative science will do an IPO that maybe in a different market environment would have waited until phase two, or frankly not happened at all. And I think that dynamic also drives a lot of capital essentially becoming trapped within these entities and committed to science projects that may or may not work. But then once they run their course, you have publicly listed shells that in certain market environments can actually be thrown out with the bathwater. And so, going back a couple of years, you had a situation where there were 200 or 300 NASDAQ listed biotech companies trading below their net cash balances. And quickly you can exclude probably more than half of those because the cash is actually committed to clinical trials. And I'm not sure it would be for me to say that shouldn't happen. I'm no PhD biologist, and I'm not trying to second guess the ultimate work that the companies are doing. But there were many others where the clinical program had actually already failed, and you had a shell that was either had already committed to pursue strategic alternatives or was thinking about what to do next. And there are a lot of incentive problems that come up there. There's a little bit of a principal agent challenge of who's making that decision on behalf of shareholders, what are the board's expectations, what have they done before, and what are their advisors telling them. And I think what you see within a lot of these entities is typically a reverse merger with another biotech that the shareholders may or may not have any say in selecting. And that has a very mixed set of results. I think a lot of private companies that would like to be public but are not able to pass an underwriting process, they see that cash pool and they think like, well, that's essentially my lead investor. I'll go pitch the public company on acquiring me. And I think if you've looked at reverse mergers more generally, their track record is not great. And it's again because of some of those incentive problems. And I think boards, before I served on one, I used to think they really might have been bad actors, but now I just understand it as more of a sense of pressure to do your duty by doing something as opposed to sometimes liquidating or returning capital actually feels like a failure, even when it might result in a better financial outcome for shareholders who could then redeploy that capital somewhere else. And so, anyway, long story short, and you'll have to cut me off on some of these answers if you like, but I took it upon myself to get involved in a half dozen of these situations in a more active way. We historically, in the previous down cycles, had been more inclined to just take a basket approach, which in terms of return on time is actually the better way to do it. Like you can play the down cycle by buying 50-cent dollars that revert to 80 or 90-cent dollars, and you don't have to serve on a board or spend time agitating for change or really going to that much trouble. And that's probably what I recommend most people to do in this situation. But I like learning experiences, and so you mentioned Aruka. That was the result of a transaction we did at Arca Biopharma, ABIO, where I served on the board for 2 years after Funicular took a large stake. And I think the key takeaway from that transaction, and the thing that I very actively encourage other biotech investors, sector specialists, and people looking at these situations generally to consider is that the the choice set before a board is basically liquidate or otherwise return capital or merge with something. And while my bias is that if the stock is trading below cash, like returning capital might be better, especially with smaller capitalization issuers, there is value to that shell. Like there's a market in listed public companies because of the time to go public and the regulatory process. I'm not sure that it's as demanding as people make it out to be, but there's cost associated with that, and an existing listed entity, there's some efficiency in repurposing it. So a reverse merger on its face is not necessarily a bad thing. It's just that there's some adverse selection, and a lot of the companies that pursue it are unlikely to be high quality. But you could certainly imagine a perfectly fine private company going public through that process. And so the thing, as I was saying, that we've tried to emphasize to other investors is that there need not be a presumption that all of the cash on the company's balance sheet needs to fund that transaction. Because in effect, what the board is doing in that case is saying, and these are made up numbers, but sort of close to where ARCA was at the time, we have 20 million of cash on our balance sheet, 30 million, 30 million of cash, 20 million of market cap, or pick the numbers however you like. We're going to merge with some other entity that's going to do a large capital raise and become much bigger. Why do they need our 20 million or $30 million exactly? Like, they just need the shot. And so what we proposed and ultimately did was we had a nominal investment in the new issuer because we liked it, but we didn't suppose for our shareholders that we were going to force them to invest all of their money effectively in this new entity. Instead, we paid out essentially the market price in a special dividend, and then the retained amount was effectively value for the listing. And they trade, in kind because you get stock in the new co between $5 and $15 million for most transactions I've seen. And so, in the context of a several $100 million shell, maybe a liquidation makes more sense. I'm not sure that there's any point really to a reverse merger as such, but for a 20, 30, $50 million shell, or less for that matter, like that 5 million, 10 million of stock could be quite material. So it's in those situations that we do encourage companies to not feel like they have to contribute all of their cash, pay a dividend, do whatever you need to do to return it. But then you can monetize the shell, and that is a superior outcome to liquidation.
Okay.
So we've seen a few of those through to the finish. There are a couple still pending. Um, we had one recently that was approached by a cryptocurrency treasury strategy, and they were happy to invest at a premium in a pipe, which is a little bit of a different structure, but one that resulted in a similar outcome for shareholders. So we were happy to go along with.
Yeah, no, that's a good segue to crypto treasury stocks. I think I know which one you were talking about that you were involved in. What do you think about this current craze, kind of in the crypto treasury stocks world? It seems like every day or two there's another couple companies that are pivoting from a failed business into them. I'm just curious what you think.
Yeah, I think it represents a bit of an evolution for me personally. I spent many years railing against digital assets generally for lack of compliance with securities law and encouraging a lot of speculative activity that I think is ultimately harmful to society. And the sad reality is that that battle has been completely lost. Congress has been captured by the crypto lobby. Essentially, it's open season on anyone who wants to speculate in these things, and you know, more power to them, I guess. But without quite going as far as to say if you can't beat them, join them, we have been rather active in that space because ultimately, as a ECM participant, we do go where capital is flowing with more of an agnostic moral stance and try not to view every securities transaction as being an expression of our values. Um, so that's the answer. That Jacob, how could you own one of these things? But at the same time, I do think that there's an interesting sort of to the extent a digital asset has any value at all and the underlying is hedgeable and has a liquid market, uh, I don't need to interpose my personal beliefs on what a Bitcoin is worth. Like, there's a market price for that. There are ETFs I can sell, and if the market is routinely going to value one Bitcoin at more than the market price of one Bitcoin when it's inside a public company, you know, I can't change that. What I can do, however, is try to isolate that premium. And so the trade that I think is really interesting at the moment, and there are multiple opportunities to monetize, is to create that new supply that's coming to market and be short the already extant higher premiums in companies like MSTR. And there are ways to structure that cap your downside risk. But the basic premise is if you can, with any underlying, forget that it's crypto for a moment, create a vehicle with a premium of 1 to 1.2 times, let's say, and sell it at 2 times or more. It doesn't really matter where that ultimately converges, as long as it does. And my belief is that there's a structural feature of the market that's underpinning that premium. It's essentially from um, equity funds that by mandate are not permitted to own ETFs or other 40 Act funds. So they can't buy IBIT, they can't buy the underlying, of course, but they have managers that, in their infinite wisdom, would like to own exposure to the digital asset. And it's those portfolio managers who are buying MSTR irrespective of premium because that's the only way they can have exposure within their structural mandates. My belief is that as more paper comes to market, additional issuance from all of these competitors, especially some of the larger DSPACs that will be unlocking within a few months, that will pull some of that institutional demand away from MSTR and into other treasury vehicles that are smaller market cap, can grow their Bitcoin per share faster, whatever other made up metrics like the Bitcoin yield, et cetera, that people seem to care about. And so my belief is that ultimately the premiums will converge to a lower number, but our trade is again a little bit agnostic to that. I think viewed from a theoretical standpoint, all of these strategies should trade at a discount, actually, sort of like a closed-end fund. But they don't have to. If we're hedged, it's fine with me if it persists for a while. And so hopefully we'll make money in both directions if we can get the timing right. But it's consuming a lot of my time and attention, and in some ways reflects years of study of this particular asset class and issuance of it, and then I'm going to participate in the issuance of it, pun intended. Issuance might not be a word, but whatever, that's fine.
No, thanks for sharing that. Another area is kind of structured financing, kind of convertible debt. That's probably a way that you can further express potentially a long position. Um, and just curious, when you started getting involved in structured financings, what attracted you to that? And I think you tell a story in one of the letters where you have to be okay with unanticipated outcomes. Like now, I believe you're the outright owners of a barley mill somewhere in the United States, and that was kind of made me smile. So maybe just talk a little bit about structured financings, why that's of interest to you, and talk about the barley mill too. That sounded interesting.
Yeah, for sure. Grand Forks Grain, located in East Grand Forks, Minnesota, right across the river from Grand Forks, North Dakota, is becoming a little bit of a passion project. I think we did not originally intend to own the barley mill, but it was our collateral for a secured loan we made to an issuer that was hoping to do one of these reverse merger transactions. It was not a biotech, but they unfortunately just hit the end of their runway with the working capital we had provided due to some delays in the restructuring transactions they were going through in order to get to that point. And we basically just ran out of time, which was unfortunate. But the barley mill, I think it's a good asset. It required some investment that the parent had not been able to make. And so in some ways, it's been a good education in actually managing a business and seeing quite tangibly what the investments that companies we otherwise are diligencing talk about, what it means to actually implement um, things as straightforward as, oh, let's add some more equipment and we can process things a little bit differently. I'm oversimplifying. Uh, it's a lot of process, and you need RFPs, and there are construction timelines, and it's not as simple as just moving the capital from one place to another. And that should be obvious, but I think it does reinforce a little bit the importance of management quality, the importance of people at the end of the day in a lot of these businesses. And I think any reminder, notwithstanding the previous discussion, that what we're ultimately doing when we invest is not just trading pieces of paper. I think one thing I've really enjoyed about running cable car the last 13, no, 12 years, time flies, but it's been getting to do both. I really like the day trading, like this is just trading sardine aspect of the job. But I also enjoy like rolling up my sleeves and working with the business on a fundamental level. Um, so going back to your question, structured finance, it's a little bit in that same category of my evolution as an investor. And I think some of the lessons I've learned from investing in microcap in particular, as you try to scale investments in that space, you do run into liquidity challenges, as you all know. And when you try to deploy more capital, there is sometimes essentially a situation that comes up where you can't do it in the market at all. If you're going to get a sizable position, it's got to be directly with the issuer. And if the issuer is in a position to take capital in the first place, it's usually because they need it. And that in turn is also a situation where you might not want to be an equity investor in the first place because if they're going to be raising more money, it's because they have some liquidity challenge. You might want to be further up the capital structure. You might want to try to figure out some way to protect your downside. Maybe they're hard assets that you could have some security against. But ultimately, you're only doing it because you still believe in the upside potential of the business. It's just, coming back to capital as a somewhat tangible thing, they need capital to do it. Like the company has a growth plan, it requires investment. That capital needs to come from somewhere. And if they can't generate it internally or raise it from less expensive providers, well, hedge funds are not the cheapest sources of capital, but we can be capital providers. And so we've tried to do that only where it's really a partnership and there's some you know longer term strategic reason to do it, as opposed to purely creating another trading sardine solely for structure's sake. Um, I'm sure there are one or two examples of where I've been kind of guilty of that, but that is not the goal. I'm not trying to run a structured pipe strategy where we approach microcap issuers and give them some kind of toxic ratchet financing or something. It's part of my evolution, though, that I'm even willing to consider it at all. I think in my earlier tilting at windmills years, I sort of looked askance at all capital providers that had any sort of the term is investor friendly structural features, because those features are often very unfriendly to other investors, not the investor in the structured paper. And that can make for great short opportunities. And we still look for that and are sometimes on the other side of some of those market participants. But where we get involved, it's generally because there is a long run plan for the business that we believe at least covers our debt if it's a debt investment. Whether or not the equity has value may be more of an optionality conversation, and we want to participate in that. So we're usually looking for some kind of upside structure embedded within the note or accompanying warrants. But again, we try not to just embed ratchet features or that sort of thing just for its own sake. It's more to protect our own downside in the event the issuer raises more capital on different terms in the future.
I mean, given all the different buckets on how you deploy capital, it seems like, and hat tip to you, it seems like you must be a very curious individual to be able to then dive into each one of these areas, in a thoughtful manner and make a go of it. In some of these areas you probably have been in for a few years. You mentioned, I think a few of them, a half a dozen kind of instances in each one of those buckets that you've had through your experience. Like, how do you then kind of go back and kind of say, okay, this was worthwhile. We did this 6 or 7 times. We learned from it, but in the end, yeah, we made a little bit of money, but it just wasn't worth, your time or mind share to devote to it.
It's one of the questions I ask myself most often. I mean, coming back to the India IPO example, like that's something that we're not currently doing because the return on capital ultimately was not high enough to justify the return on my COO and traders time overnight, for example. It was a lot of fun. We learned a lot about the structural dynamics of the market, and I think we can file that away and it'll be useful in the future. So with a lot of investments, I don't regret doing it as long as I've learned something from it that can potentially be applied, and who knows, maybe in larger size in the future. So we're sort of just always trying to add new arrows to the quiver, and I can fairly be accused of being a little unfocused, and I would be a terrible coverage analyst. We let a lot of things go by, but at least within the capacities we've developed, I think the idea is that we'll be there, we'll be ready if something truly large enough to get our attention presents itself. Um, so we do a lot of kind of postmortems on trades, and it's obviously not just the return on capital, but also the return on time that dictates whether we'll do it again. I think the experience with Arca and Aruka was ultimately a profitable investment, but the time commitment of actually serving on a board myself is something that I'm going to think twice a little bit before doing again. Not to say never, but it's probably not the most likely use of time. That being said, we saw idea flow from it was more than 100 private companies approached us, and I never would have had that kind of education on the private biotech market at that point in time without that strategic alternatives process. And being able to just participate in that was deeply educational for me, and again, a lot of fun. I mean, it's what I like about the job. Like I said at the beginning, not having to ever actually choose what my interests are.
What I had a question come in. What materials do you regularly read to source all of these interesting strategies and stay vigilant in the market? And if there is one or a few books that shaped your investment philosophy?
There are a few different books that have been influential along the way. My news diet is a little bit broken, as I think everyone's is at the moment. I used to be quite active on Twitter. Can't really um, stay in the environment there anymore, even though I miss some of the idea flow that generated. Um, I read major publications, financial publications, Bloomberg, as you would expect, day to day. But at the moment, to be perfectly frank, there is not a great source for me to recommend of like, oh man, this is the watering hole. Like everyone is on, Value Investors Club or something like that. Microcap Club, that's the place to go. It's maybe the answer I should give.
Thank you.
But it's become quite fragmented, right? And I think that also within the information environment, thinking about politics, and it's a real challenge for our society that I don't have good answers for at the moment. But books are good. Books are a little more permanent, and I think you can learn a lot from reading. And the main thing is just to read widely. Earlier in my career, I read, actually worked with Tim Collar and Werner Rehm at McKinsey, who wrote Valuation, which it's a dry read, but as textbooks go for how to value and measure the value of a company and think about return on invested capital, I think that remains influential in terms of how I think about fundamentals. Um, a long time ago, obviously read some of the Ben Graham kind of Bible type, works on investing. But other things that I remember today, I really enjoyed Random Walk Down Wall Street, which even though the thesis is sort of the opposite of what I do, that maybe everyone should just go to index funds. I think that's actually good advice for most people who aren't going to devote all their time to it. I enjoyed, even though he can be a little out there, I enjoyed Taleb's books. I enjoyed Margin of Safety, which is out of print, but good friend generously got a copy for me, which I don't even like to open because it's sort of a treasured piece of material. And for short selling, Catherine Staley wrote a good book on the art of it. But a lot of these things are things I think you learn best by doing.
Mhm.
You experiment, you learn from your mistakes. They're good stories sometimes. David Heinemann's book was super entertaining. I don't know that taught me to do anything so much as just showed me some of the mistakes I would actually have to make myself a few years later. Didn't prevent me from it.
In the current environment, do you feel like you have more capital than ideas or ideas than capital?
It changes pretty frequently. At the moment, we're pretty heavily invested. We're finding a lot to do within this digital asset treasury strategy I mentioned. Um, but a big component of what we do day to day is more short term in nature. So some of the catalyst oriented short selling, arbitrage-driven transactions. We're involved in some risk arb situations. We're constantly recycling capital through things of that nature, and it's an environment where there's a lot to do, but we still have excess capital in case there's more. I guess is the best way to put it at the moment.
Well, what does the turnover look like, kind of in a fund like yours?
It's a lot. I mean, if we buy a SPAC IPO and sell it that day,
Right.
it's going to be a large dollar amount that looks like pretty high gross turnover. So if you actually calculate that metric, I mean, probably over the course of a year, several times the fund in terms of gross transactions would would be transacted in a typical year. But then we have some positions like I was telling you earlier, the shipping company I wrote up for Microcap Club 10 years ago, we still own. So Pangea Logistics is still there. Still like it. There are times where I add, times where I trim. Small now, but I still think they're great owner operators, and I think that actually their recent merger is a little bit underappreciated as well. So we not a recommendation, by the way, just an example of something where the turnover on that name on an annual basis, that piece of the portfolio alone is it's not zero because, as I mentioned, we have added and trimmed at times, but it's pretty close. So it varies. Is the most accurate answer.
Do you have any kind of buckets of investing where, I mean, it seems like I don't want to frame you as you like to hit singles and doubles, and you're conscious about risk as well. Um, so is it more of a batting average versus slugging percentage kind of approach that you feel more comfortable with?
Um, I think it depends on the type of investment. Like I'm not gonna shy away from a 10 bagger. I'd be perfectly happy to have more of those. And we've had a few on small positions, or even things where like you get some non-redemption agreement stock from a SPAC at zero cost basis, and then you sell it for something. And is that an infinity bagger? I don't know, but I think yeah, when I've calculated those metrics, I've been reasonably happy with the numbers, but it it does vary a little bit by type of investment. So on the short side, I think there's historically been a very high batting percentage, and what I've focused on most has been the sizing element because the ones that go against you can be obviously ruinous, and so you need to carefully manage your position size and where we've gotten things wrong. Sometimes I've been actually quite happy to buy at 4 or 5 times my initial cost basis in order to protect capital and live to fight another day. So that's super important on the short side. But then again, batting average is like very high. Um, Slugging percentage, I think sizing is more art than science. People will point to Kelly criterion or modified Kelly or something. I think that subjective probabilities are sometimes misinterpreted by portfolio managers, and what you really want to make sure you do um, is not lose money. And so a focus on downside protection and avoiding permanent capital impairment is an important component of what we do when sizing positions. Uh, and I think it does also get to the duration of the investment a bit too. We would tend to look for a smaller return on something that we're involved in for less time because it'll generate a high IRR. And other times it's actually not even something that goes through my mind at all because there's sort of obviousness, and the constraint is, well, how much of this can we actually do? And those are usually the things that consume most of my attention day to day.
Yeah, it seems like the SPAC arbitrage strategies that you're doing, that and maybe the crypto treasury stock kind of bucket is probably something that's appealing to you because you can put more capital to work in those types of areas. Would that be correct? Versus
Um,
you're only
yeah,
going to see so many
partly
other
true.
things.
The crypto treasury thing is interesting because it's one of the most scaled opportunities to deploy capital at the moment. So it is somewhat unusual, actually, for this type of capital flow, I think, in its size at the moment. So that's one reason that it's large for us. But actually, most of the SPAC ARB and related trades are more in the capacity constrained bucket of things that we do. Um, an example would be, SPAC warrants. When target is acquired, sometimes there's a formulaic Black-Scholes calculation of what the warrant will be cashed out for, and oftentimes the warrant will trade at a discount to that going into closing because the mechanics of actually exercising are very complex and irritating, require a lot of capital and coordination with your PB. And we've done it a few times. One of them is actually subject to litigation. It's a mess. But a friend of mine pointed out one recently, and it's a good illustration of this. Like, well, what's the right return on it? You know, we bought warrants for 70 cents that we knew would be worth 88 cents, 87 cents for, in a month. So that's a great trade. I mean, you should do that all day long. But we also bought every single warrant we could, and it was still 10 basis point contribution to the fund. And also something where, I don't know, probably took me 10 hours of paperwork because there's a funky withholding tax angle, and we had to go get a withholding tax certificate from a foreign government, and just some of the alpha actually can come from that work and experience, and I love it, but like it's definitely not for the faint of heart, I guess.
How do you how do you how have you set up your organization? Like how do you keep a handle on all of these different areas? Just tell us about your firm, maybe how many analysts are currently working with you.
Yeah, we're working on that right now. Last couple of years, as we raised more capital and institutionalized, it really transitioned from, me at home with the dog in an apartment to sitting in an office, hiring a couple of people. Um, I've been fortunate to have a great partner in my COO and trader, Evan Urich, who joined me 2 years ago approximately. And together over the last couple of years, we've been doing a lot to build out the custody relationships that you referenced earlier and just make the business more like a formal business. Um, it's still a work in progress. We had an analyst who didn't work out. I'm in the process of hiring likely two more. Um, and I'm pulled in a lot of different directions, as you can tell. So part of the hope is that we'll be a bit more efficient about not letting so many ideas get past us, and chasing down in a little more detail some of the ones that we do look at. So it will probably only ever be for people, maybe an intern at some point. But that's the current plan.
Okay. So you're so everybody that's listening, he's looking to hire two analysts. What type of individual are you looking for?
We've got a job description up on the website. I'd say we're closer to the end of our hiring process than the beginning, but still happy to talk to people. Um, and it's a very bespoke role because of the sort of unusualness of what we do. So I think I point anyone interested to the job description for the best summary that I
Yeah.
could even provide on the spot.
Okay, excellent. I wanted to maybe the last thing I wanted to bring up was one of the things you mentioned in your letter. Well, really the first two-thirds of it. You mentioned a $1 million personal commitment you and your wife have given to I forget the name exactly of the organization, but you referenced the problem and how you're putting your money where your mouth is, and that's always something that attracts me to any individual anyway that puts their money behind their convictions. And so I just thought I'd give you the floor to talk a little bit about that.
Yeah, thank you. And that was part of, as we talked about, why I wanted to do this. And I think it's very uncomfortable for me, like maybe most people, to talk about personal giving. I think it's one of those things that's so much an individual decision that a lot of people want to keep it private. And especially in matters of money, there's just some awkwardness about it. But I really feel like right now there's a very compelling, at least it compelled me situation that I just want to try to bring more awareness to, which is the impact of the US government's humanitarian aid cuts that I think were made this year for ideological reasons in ways that were not very well thought out. And we're seeing a lot of the impact of that right now with life sustaining programs in parts of the world that are not as fortunate as ours being sort of summarily stopped. And I think the message I want to send to the investment community, and prompted me to write a letter for the first time in 4 years. I'm no longer as publicity seeking, I guess, as I used to be. But the reason I really want to emphasize it to investors who, not to paint with too broad a brush, I think tend to be a little bit more conservative in their at least economic principles, is that if ideologically your belief is that the government should not be providing aid to people, that maybe it creates dependencies, or you have some concerns over the efficiency of how that money is spent, um, I can respect that even to the extent I disagree with it. But I think that the responsible thing to do in that case is to ensure there's a proper transition. And if you have previously created a dependency, and let's be honest, we have collectively as a society that's been the role and function of US foreign aid in the developing world. And I would, as an aside, note that it's been very productive, and we've lifted a lot of people out of extreme poverty and encouraged economic growth, and done a lot of things that I think conservatives, in their heart of hearts, should really support. Frankly, demonstrated the value of capitalism at the end of the day. My strong belief is that even if you believe that should stop and stop completely, that there needs to be an off ramp. You can't just, as a recent example demonstrated, send a bunch of sorghum to a warehouse in Zimbabwe and then refuse to pay for the trucks to take it to the market. Like, it's asinine. I mean, it's funding that was previously committed, that was planned for, that the infrastructure is in place to distribute for the last mile, and there's frankly no justification for it other than, not to let my personal animus get in the way, but other than a few individuals exercising their biases and perhaps racial animus at the end of the day. So, what can be done about that? The message I really wanted to relay, and to be a little bit more positive, this has given me some sense of agency and feeling like even in a political climate where a lot of things are happening that I don't agree with, even if you do agree with them, there's an opportunity right now to step in as a private donor and do what the US government used to do through its funding partners, its implementing organizations, which are vetted, well run and managed, audited organizations, 501c3 nonprofits like the International Rescue Committee, like CARE, like Save the Children. I could name more, but these are all organizations that do humanitarian work around the world and have just had their grant programs that the US government, in a, again, conservatively minded public private partnership, where the government paid them directly to do specific things like distribute basic medications to populations in war zones, to provide anti-retroviral therapies to people living with AIDS so that mothers won't pass it to their children, so that they can lead normal lives. Um, Providing ready to use therapeutic food to people in famine zones. I think that these are things that actually, when you stop and think about them, they have almost universal support. Uh, Again, dependencies aside, maybe some people feel that shouldn't be the province of Americans, but there's an opportunity. If it's something that's meaningful to you, I looked at that and thought, someone should step in, someone should do something. How can I help? Like people do after a natural disaster. And thankfully, there's some former USAID staffers who went to the trouble of actually triaging a lot of the programs. And they've done the yeoman's work of going through the grant programs and talking directly with the implementing organizations, trying to figure out, okay, what do you have bridge funding for? What can you use unrestricted funds to pay for? What is, absolutely critical, like life sustaining care, as opposed to lots of other projects that are worthwhile but just aren't going to happen anymore. I mean, say what you will of experiments in developmental economics, that they're just stopping in favor of getting food relief to people who are going to die without it, in a very concrete way, and medication, essential childhood illness care, anti-malarials, etc., to people who do not have it. Um, Big picture, I think that is the biggest return on investment you can get with a dollar today. It's a 10 bagger, it's better than any stock I could imagine. The feeling of, specifically one thing we funded, is one of several projects actually, but was work by the IRC in Burkina Faso together with a partner. We're going to make sure for the next 11 months until, fingers crossed, the next funding cycle for international other sources of aid that may materialize but aren't here on the right timeline. We're keeping some rural clinics in the Sahel in Burkina Faso, which is a conflict zone, operating, and about 100,000 children who every year are exposed to malaria or have other childhood illnesses, they still get to see a doctor and get anti-malarial medication when they need it, which is explicitly something that will save your life, and it's cheap. It costs almost nothing. Most of the expenses for staffing the clinics and getting supplies to where they need to be in region. And I just think about how cheaply, it's less than $1 million to sustain that many people's lives. It's almost a no-brainer, and it's quite unusual in the context of humanitarian giving generally. There are always programs that could be funded. There's always need. But right now, this is the obvious stuff that governments do. This is not what private donors typically do. Private donors are the ones doing the little experiments or giving some unrestricted funds to their preferred organization to pay for staff in New York, right? Or to pay for more mailers to raise more money. I mean, all the critiques of NGOs have some base validity, but I mean, we're talking about opportunities to take a government grant that spent a year of vetting, has a 600 line item budget, and everything except the capital source, which was going to come from the US Treasury, is ready to go. And private donors can just step in and do that. So anyway, the organization is called Project Resource Optimization, PRO. Their website is proimpact.tools, and they have listed a number of these high priority projects from their efforts so far. I believe of about 100 million in identified opportunities, about a quarter of that has been funded by private donors so far, which is awesome. I wish I could say that 100 million were the entire gap, but it's actually 100 that's been whittled down from 10 billion. So you're looking at a very small subset of just, these are some of the lowest hanging fruit, and it's galling to me that it would go unfunded. So we chose to advance some of our kind of lifetime giving plans, and I just want to encourage others who may be thinking about that sort of thing down the road that actually now is a really good time to think about how you might have greater impact than, let's all hope, any of us will at any other point in our lives. So Thanks for listening to that.
No, thank you, Jacob. Thanks for bringing this to our attention, and thanks for telling us more about yourself, your strategies as well. And anyway, you gave the information at the end to reach out to those organizations and give to them. So thanks for coming on and telling us more about you. Appreciate it.
My pleasure. Yeah. Thanks for having me.